Commit to Wealth Nation, welcome to the Commit to Wealth podcast. I'm your host, Juan Vargas. Today on the show, we have Marco Santarelli. Marco began his investing career at the age of 18 and continued building his portfolio over the years. He's the founder of Norada Real Estate Investments, a turnkey rental property company that provides properties nationwide, and he's the host of the Passive Real Estate Investing podcast. Marco, welcome to the show.
Thank you, Juan. I'm honored to be here. This is going to be fun today.
Hey, it's going to be awesome. So I want to tell you, thank you, first of all, for your time. I really do appreciate that. So let's go ahead and, let's dive into the podcast. So, I always like to start with you. Who is Marco? Tell us your story there a little bit.
Yeah, thanks for asking, Juan. So basically, I consider myself an investor, a family man, an educator, an author, just a serial entrepreneur. I've been entrepreneurial since I was a teenager. I started coding when I was 13 years old. I literally taught myself what was known as assembly language. Nobody ever uses that today, even though it still exists. So I've always been a serial entrepreneur. And, I have a daughter and a wife, and I just like to give back and help educate people just like what you're doing. And so, that's just a quick snapshot of who I am. But, one of my passions is really focused around investment real estate to help create financial freedom and passive income for not just my family, but for the people that we talk to.
Gotcha. Yeah, no, that's what it's about, man. It's about, having what you learned over the years and then, give back because, frankly, not everybody knows about real estate investing. We hear it a lot. For us, it seems like everybody knows about it because we're involved in it every single day. So it seems like, in our world, a lot of people know about it, but the reality is there's a lot of people out there that don't, and that's what you're trying to do. You're trying to get back and educate others and, help them create a good lifestyle for themselves and for their families. So, why real estate? Why real estate out of all things? You could have chosen many different paths. What was real estate?
Well, it was kind of accidental, one. I saw when I was a teenager that a lot of the people around me that I didn't know at the time were wealthy, and I came to learn that. And the one common thing they had, the common denominator, is they all owned real estate, and more specifically, it was residential income-producing real estate. So these were single-family homes, duplexes, in some cases fourplexes. I don't think I knew anybody that had anything larger than that, but the common denominator was real estate. And so I think it's just kind of it's kind of common knowledge, even though it's not as common as it should be, but it's kind of common knowledge that people see real estate as a wealth creator and a place to store wealth. We just kind of associate wealthy people with real estate. And so I learned at a young age that that's where it's at. And I made the decision early on that that's one of the things I wanted to do. So when I turned 18 years old, which is the age that you needed to be at the time in order to qualify for a loan, I made the decision to purchase my first rental property. So I bought a unit, I fixed it up, I put a sign on the lawn. There was no internet back then. I leased it out, managed it myself, held it for a number of years. I didn't read a book or take a course. It just worked out because I guess I thought about it enough, but it was pretty much a textbook case. And it was a great investment. I got cash flow and I got some, equity growth over the years. The biggest mistake I learned, and sometimes we learn more from our mistakes than we do from our successes. In fact, that's probably true most of the time. But the biggest mistake I made at the time, not knowing it at the time, was I sold the property years later. I walked away with, a good chunk of cash, but I basically killed the goose that laid the golden egg. I no longer had the cash flow. So I didn't reinvest that money, at least not right away. I don't remember what I did with it, but I'm sure I blew it on stupid things. But the lesson learned is you never sell real estate. You can exchange it. You can do it tax-free with real estate, which is one of the beautiful things about real estate. But never sell your real estate. Move it, preserve it, but don't sell it.
Yeah. And if you are going to sell, then make sure that you're going to reinvest those proceeds into another deal. Keep it moving. Don't just sell and sit on it, sell and reinvest it. You got to keep it moving. And that's really how you create wealth, is by holding long-term, as you said. But if you are going to sell, if there's a reason for sell, then make sure that you keep it rolling, So I like that. But I want to go back to, you mentioned 18. and it's just crazy just thinking about it, because most 18-year-olds out there are not necessarily thinking of real estate. They're not, they're busy, maybe through college, or they're busy just having a good time, partying, whatever. But you were buying your first property. I mean, that's just crazy. So, talk about what kind of mindset you had to have at that moment as an 18-year-old, and even as adults, as we get it, into later years, we still don't have that mindset a lot of times. So talk about how important it was for you at that time, and how important it is for everybody, really.
Well, I think when you're young, you're a teenager, and even in your 20s, you're not really thinking about retirement or your financial future. You're still thinking about school and going out with friends and having fun. The problem is in the public school system. Well, in the school system in general, particularly in the public school system, they don't make a point of teaching financial education. So we don't have financial literacy growing up. Unless you grow up in a family that's what you talk about at the dining table,
Mm-hmm.
you never really learn financial education. You just don't get it, or get very little of it. And if you do get any of it, it's usually at the college level or the university level. So I guess my motivating factor, this goes back so many years, I really don't remember, but I think just the fact that I had an entrepreneurial spark or spirit in me. I just knew that I wanted to have that freedom, meaning not just financial freedom, but what we work towards today is that time freedom to be able to do what you want, when you want, on your own terms. But in order to have time freedom, you have to have financial freedom. I think I saw that or recognized that fact early on. And I think that's true for most entrepreneurs, regardless of age. They just realize that they don't want to be, tied down to a 9-to-5 job or, career. So I guess I just, followed my heart, followed my passion, followed my gut, and real estate was one of those things. Now, mind you, there's two things I really, really love, and this ties all back to financial freedom and creating, cash flow and all the things that you want. There's really two things you want to focus on, in my opinion, and this is not true for everybody because everybody's different. But ideally, it's good to have your own business, a business that's built around systems, not built around you. So you could literally go on vacation for 2 weeks and come back and you still have that business, you still have that cash flow. And then you take that income and you roll that into real estate and build your real estate portfolio to create that passive income through passive investments. That model is the ideal model. Now, granted, that's not for everybody. Not everybody's an entrepreneur, and not everybody wants to own a business. So the secret there is if you're an employee or a self-employed or a professional of some kind, like a doctor or dentist, where you are the business, you can't walk away,
Mm-hmm.
but you do make a decent income or a good income. The key there is take that income and continue investing it in assets that generate streams of cash, like real estate, like your real estate syndications, like your single families and duplexes, whatever it may be, because you've got the leverage, you've got the tax benefits, you've got the cash flow, and you've got equity growth. That's the secret right there to creating wealth, is converting that earned income into passive and portfolio income. If you can figure that out, if you can get that down, then you've got the key. The rest of it is just execution. It's just doing it. And so this is what I would, this is what I would end on really with you today, is just that one fact, that one key. But I learned that quickly enough in life to know that that's the secret formula.
That is a secret formula. And I actually had breakfast this morning with an investor, who has invested with us in the past. We had breakfast, and that was one of the things that we talked about. That exactly, same kind of conversation was, if you, and he's a business owner, if you are wanting to focus on your business, then keep focusing on your business, because he's got so many employees, and he's doing a good job. He's doing a good job. He's successful. He's not planning on letting it go. So use that. Use your capital, your extra capital that you have there on the side, and put it to work. Keep focusing on your business, your extra capital, put it to work. Same thing with dentists, doctors, attorneys. A lot of these professionals that like you said, they are the business. They're not going to let go of their clients or their patients, or
Right.
so they have to be there. So yeah, you said it right. So let's focus on what you do, and that is Turnkey Real Estate Investments. And why Turnkey? And first of all, what are Turnkey? properties? And then second of all, why? Why is it a strong choice?
Those are two great questions. So let's start off with what is it, and then we'll get into the why. So I started this business 15 years ago, and the word turnkey was around at the time, but it wasn't really used much, and it wasn't marketed. I marketed the snot out of it, 15 years ago when I launched the business. People use that term loosely, and some people confuse that term with properties, regardless of the size or scope, as ones that are rent ready. You can look on the MLS, the multiple listing service, and find properties that are rent ready. They may have, issues. They might be in bad locations. They might have deferred maintenance. There might be capital expenditures that need to be spent on it, but they're good enough to be rented or leased. They have a tenant in place. They're cash flowing. That's rent ready. But that's not good enough. I wanted to raise the bar. Our definition of turnkey are properties that are in good markets, which we can talk about here in a minute. But think of it as a funnel. Good markets, good areas, good neighborhoods, a good property, and then that property and you are surrounded by a team of people that support you and help you to be successful. So that is the definition of a turnkey real estate investment. Now, the experience and putting all that together, which is what we've done, is the turnkey real estate investing experience. So it's really just everything under one roof to allow you to go from A to Z and successfully build a portfolio regardless of the size of the property, single family, duplex, fourplex, whatever. Now, to the question of why, so now we know what a turnkey real estate investment is in our definition. The why is pretty simple. Most people, and I'm going to say a lot of people, but probably most people, are very busy. They have their careers or their jobs. They have a family. They have their friends. They want to go to Johnny's soccer game on the weekend. They're basically busy and following and doing the things that they do on a day-to-day, week-to-week basis. They don't really have the extra time to fully educate themselves, to assemble a team and vet that team, to do market research on the markets and find the markets that make sense, to find the properties or have a team that they assemble and vet to find those properties, and then go through the whole motion of executing on all that, especially if they want to take a more active role of finding a distressed property, fixing it up, and then putting it into their portfolio. That's even more complicated and carries other risk factors. So it comes down to being a great solution for people who I would just refer to as being busy. And it's just a great way to do it because it's not essentially a done for you model, but it's about 80% done for you. You still have to be involved. And there's still some due diligence, but once you close escrow, you put it in your portfolio and you have all your payments automated. Guess what? It's on autopilot. You just track your income and expenses every month, which also, by the way, can be automated. And you just build your portfolio, collect your income, and let your wealth grow year after year.
Got it. So this is a strong model. And one of the things that I like about it is that, as you mentioned, it's kind of packaged for you, right? So it's a property that's, you don't have to necessarily be involved in any kind of rehab because it's turnkey. It comes with a property management company, or you can assemble it that way, right? Where a property management company is already overseeing the property. They're the ones handling the day-to-day operations. And so your job is to basically read what they send you and to cash your check. Well, not even a check is ACH payments these days, but that's your job. But the other thing I would add to this is that it can be for anybody throughout the nation. But I would say maybe it's a little bit even more favorable for those that are in a high, where it's high values, where the properties don't make sense. You cannot cash flow, so you have to invest like out of market, out of your own backyard, right? Is that something fair to say?
That's huge. Yeah, we have a lot of investors that, I shouldn't even call them investors, people. We have a lot of people that come to us from the coastal markets where property values are very expensive, and it's hard to invest in those markets because you're talking single family homes that are $400,000, $500,000, $600,000, $800,000, and they don't rent for enough. Those properties, same properties, will rent for $3,000 to $4,000. It's essentially what we call a rent to value ratio, or RV ratio for short. Essentially, it means this: if you buy a $100,000 home or any unit that's $100,000, ideally you want to see it rent for 1% of that, so $1,000 a month. That's a 1% rent to value ratio. The higher that number, the better, but within reason, because you can go into sketchy neighborhoods and see that number go up, and now you're creating other problems. So assuming that you're in good neighborhoods, what I'll refer to as a B plus, or maybe an A minus type of area or neighborhood, and you're achieving that 1% plus or minus rent to price or rent to value ratio, you're in really good shape. You don't base your decision to buy based on that, but it's a litmus test, because that tells you a lot, tells you whether you should continue doing your due diligence.
Mm-hmm.
Now, you can't do that on the coastal markets. Here where I live in Southern California, we're looking at 0.4, maybe 0.5%. So that we don't have $100,000 houses here. That's a garage. But the $1 million house,
Mm-hmm.
Should rent for $10,000 a month, but really you're getting $4,000 a month, maybe 45, sometimes 35. I mean, I've even seen those. Numbers don't make sense. So it's exactly what you said, Juan. We're in 22 markets, and those are mostly in the Midwest, the South, the Southeast, and pockets of the Northeast. And the reason we're in those markets, and we have probably 200 properties available, to invest in or to purchase at any given time. The reason we're in those markets, because the economy makes sense, the fundamentals are there, there's inventory, we have the right teams, and the numbers make sense. That's the bottom line. You can invest and get an immediate rate of return, and you still have price growth over time.
Gotcha. So speaking of markets, which markets are some of the best ones currently right now that you'd see a lot of, I wouldn't say like investors, that's not maybe the right word, like you said, but like a lot of people that are buying these turnkey properties, where are they buying like today, these days?
It's funny when I get asked the question, what's the best market or what's the hottest markets? Because it really comes down to how are you defining. I had a magazine approach me once and wanted me to write an article about the top 10 hottest markets. And I said, well, what do you mean by hot? It's like, I kind of stumped them. And it's like, well, I don't know. When you talk about the best, it really depends on how you're defining it. For some people, those are the sleeper markets, the boring markets. And I'm not picking on, Memphis or any market in particular, but I consider Memphis a bit of a boring market. Great. They have great barbecue. They have, the barbecue festival every year. They have interesting things. They're on the river. It's a beautiful place, but I wouldn't live there. It's not my home, but I like Memphis. It's a great place to invest. But to me, it's a very linear market. It's a slow and steady. It's kind of like the turtle. It's got steady growth, varies by area within that market, of course. But it's been tried and true. It's a perennial market. You can invest there. You can find inventory, invest there, get immediate cash flow. You have a good cash on cash return, and you can build a portfolio of those properties, or at least start a portfolio there, and then work to other markets. But that's a steady Eddie type of market. But then you look at other markets that are more cyclical in nature, and I'm not talking about Southern California or New York or New Jersey, where you see huge price swings. I'm talking about areas that are more of hybrid type markets, like, for example, Jacksonville, Florida, another market that we're in and we have inventory. So Jacksonville has strong growth, has had strong growth, and continues to have strong growth. The prospects are pretty darn strong there for continued price appreciation. That's not the main reason you want to invest. You don't chase appreciation because you're speculating. But you've got the cash flow, you've got the rate of return, but you can build a portfolio there and have stronger price appreciation than you would in a more linear cash flow market like Memphis. So when you talk about best markets, best for what reason? For some people it's going to be Memphis, for other people it'll be Jacksonville, Florida, and for other people who like to roll the dice and be more speculative and try to time the market, they might choose parts of California like the Inland Empire, further in where it's not as cyclical, but you still have that strong demand. So it's really
dependent.
Really subjective.
Yes. Mm-hmm. Gotcha. Okay. So you have 10 rules for successfully investing in real estate.
Yes.
Can we go through those 10 rules? And I know that, you can go deeper into those, but yeah, I want to at least cover those, make sure we cover those. So let's go ahead and start with those. All
right. I'll do that as I fight my cold here. So I apologize. Okay. So let's run through them, because we could literally create an entire 1 hour episode on these if we wanted to go deep into it. But sure. I think I could run through them and give you kind of a taste of what they are, because if you internalize these and you follow these, you're going to help avoid making a lot of mistakes. Some mistakes could be quite costly. But the first is the first for a specific reason, and we've been talking about it today, but it's really all about educating yourself. Knowledge is the new currency, because you can apply that knowledge and do great for yourself and other people. It's the difference between knowing a good deal and a bad deal and a great deal. It'll make you a better investor. It'll make you financially literate, so you know what questions to ask when it comes to your CPA, your attorney, or your real estate agent, or whoever the people are you're working with. So the more you learn, the more you earn, is typically the saying. So educating yourself is critically important. I put a lot of weight on that. This is why guys like you do the podcast, is to help educate other people, to pass that knowledge and experience on. Reading books is a great tool. There's a lot of great free information online, reports and ebooks. I mean, you can educate yourself freely today. There's no excuse not to educate yourself.
Mm-hmm.
It just bothers me when people don't.
Yeah, I agree 100%. Yes. Mm-hmm.
So educate yourself is the first one. That's the starting point. That kind of segues into, number two, and that is set investment goals. A lot of people don't bother to think about it. They wish they were rich. They wish they were wealthy, but a wish doesn't materialize. It doesn't necessarily mean that you will become rich. But when you start setting very clear and specific goals, you write them out and you start breaking them down into steps, like measurable, attainable, bite-sized steps, that becomes your action plan. And if you can execute off of that, guess what? You're going to be further ahead than you are today, tomorrow, and next week, and next month, because now you're just laying out the path to achieve whatever that goal is. And statistically, people are more successful. This has been proven time and time again. Research has shown that people who actually take the time to write their goals out and make them clear and make them specific and put a date, like a time frame on it, are far more successful. And I don't know what it is, call it the law of attraction, but it just puts into motion something in your mind, your subconscious, and around you in the universe. You just bring to you the things that you need. You ultimately see them or find them. So set investment goals.
It's just crazy the way it works. Same thing with me. Like I write down my goals, and it just seems like, I write it down and it happens, and I write it down and it happens. So guys listening, please make sure you do that. It's not crazy. You're not being crazy by doing that. Do it. So number three.
So number three is never to speculate. Don't be a gambler. This is the problem with people that were so-called quote unquote investing back in 2003, 2004, 2005. Before the Great Recession and the housing market implosion, is people were buying property thinking they were investors, but they were really just wanting to flip that house 6, 12 months down the road, and just, let it appreciate, 5, 10, 15. Sometimes I've seen appreciation rates as high as 30% in some markets in 1 year, which is, is completely unsustainable and crazy. But when you're flipping houses, you're creating chunks of cash. It's not cash flow. So you're really just speculating. You're just chasing after capital gains, which is not tax favored anyway. So don't speculate. We will all grow wealthy through holding a portfolio of real estate. You just have to give it a little bit of time, but invest for cash flow first. And that's my fourth rule, is invest for cash flow. There are rare exceptions here, of course, but when you build a portfolio, you want income coming in right from the get-go. It needs to make financial sense. The other thing about investing for cash flow is it really is what I call the glue that holds your investment together. And your equity will grow over time, no question about that. But when you have cash flow, positive cash flow, what happens is that income coming in from the tenant covers all your expenses, covers your debt service. Everything left over is spendable cash, goes in your pocket. Now, I would just save it and accumulate it as fast as possible and redeploy it into more property. But that cash flow is what keeps your whole portfolio together, working, and it creates your wealth over time. And then as you pay off the debt service, if that's your strategy, guess what? Now you're making thousands or tens of thousands a month in passive income after you've achieved whatever goal it is that you're trying to achieve. So invest for cash flow.
Okay.
Any questions there?
No, I mean, I agree with you 100%. Cash flow is where it's at. Do not speculate, which was number three, but invest for cash flow. That's so important. Yes.
Exactly. So the fifth, number five, is to be market agnostic, which is really the model we have built on. I told you we're in 22 markets. There's a reason we're in 22 markets, is because we know that for a lot of investors, a lot of people that we work with, their backyard where they live doesn't make sense. So they need to look at other markets. So we've gone wide because we need the depth of inventory in the different markets. But being market agnostic means this, that you don't marry yourself to your backyard. A lot of these so-called quote unquote gurus say, invest within a 1 hour, 2 hour radius of where you live. That's a flawed piece of advice, because if you're not lucky enough to be in a market, or in a good market, but at the wrong time, where you can create deals for yourself or find deals for yourself, then you're stuck. Just because you live nearby doesn't mean that it makes it a good deal. Just because you can drive by it on your way to work every morning and see it and maybe touch it and know that it hasn't burned to the ground, doesn't make it a good deal. It doesn't change the numbers or the return on investment. So you need to think of this like investing in the stock market. If you wanted to invest in Coca-Cola and you live in Southern California, I don't need to live in Atlanta, Georgia to be able to invest in Coca-Cola, where they have their corporate head office. It doesn't matter. That's just silly. You can invest from anywhere in the world when it comes to real estate. It's just a matter of doing your research, identifying the markets and the properties, and having the right team around you, because the technology's there, the people are there to help you do that. So there really is no excuse. And people do this by the thousands every week, every day.
Yeah. Yeah. I think on that one, if you are in a favorable market and where the numbers truly do make sense, then yeah, look at your backyard. Don't at the same time, don't just limit yourself to your backyard though. That's kind of what Marco is saying and referring to. Especially if you're in a market that doesn't make sense at all, then, you can invest anywhere. You can be, in San Francisco, and invest, in Memphis and, in the Midwest, in the Southeast, wherever. It's just about the return, it's really what it's about. So, good. That's number 5. So number 6.
So we touched upon this before, and that is taking a top-down approach. If you think of it like a funnel, it's always start with the market in mind. A lot of investors make the mistake, knowingly or unknowingly, by looking at a quote-unquote deal. So they're presented with a property, whether it's a small apartment complex or a fourplex or a single family, whatever it is, and they're saying, well, here's the information on this deal. It's been renovated. Here are all the photos. It's in good condition. Here's the income. Here are the expenses. So you get a pro forma, and everything looks great. It's all on paper, but it all looks great. But a lot of times what's omitted, or the question is never asked of, okay, what is the street it's on? What is the neighborhood like that it's in? What are the demographics of that area? What is the market like? I've bought properties in areas of, let's say, Detroit. This is, true, because this is where I was investing back in 2004. I was buying properties that were great properties. They were beautiful. I mean, so beautiful that I'd live in them. They were just like new. But they were on a street that was, very sketchy. There were burned down houses, literally, what we call them burnouts, in a very sketchy neighborhood, and you have very transient tenants, and you have all these kinds of issues. And I mean, I even in front of one of my properties, I literally had someone shot. So, if you don't consider the neighborhood and the area and the market, whether there's growth, positive migration, negative migration, are there jobs? Is there job growth? If you don't consider those factors, then you're being myopic. You're making a mistake. You need to start with the big picture and work your way down.
Mm-hmm. Good one. Yeah. Okay.
So number 7 would be to diversify across markets. And this is true diversification. It's a geographic diversification. Because what you would do when it comes to real estate is you'll start to build your portfolio in a particular market that you've chosen to be the best market for you at that time, that fits your investment goals, that fits within your investment criteria. Mm-hmm. And you'll build a footprint there. I like to say 3 to 5 properties in 3 to 5 markets. So accumulate 3 to 5 properties, it could be more, in that one market, and then you move to another market. Typically that'll be in a different state. You want to separate yourself geographically, and you rinse and repeat. You do the same thing. You start to accumulate 3 to 5 properties and you build upon that. So once you've diversified across 3, 4, 5 markets and you've got a sizable portfolio, mm-hmm. You're well on your way. You've established a very good foundation for yourself. So now, of course, there's the talk about diversifying across different asset classes. Sure, you're welcome to do that. But, to me, real estate is the best investment class, the best asset class, and the most tax favored investment class. So this is where I think most of your audience should stick to.
Okay.
Yeah, I mean, we could go on about that, but really that's what diversification, across markets means.
Okay. So number 7 was diversify across markets geographically. Okay. So number 8.
So number 8, could be argued that it should be common sense, and that is to always use professional property management. Thing is most of us are not professional property managers. We don't necessarily know how to properly screen and qualify tenants, how to negotiate with them, how to deal with tenant issues that come up. We may not have good marketing skills. We may not be familiar with tenant landlord laws. But if you leave that to a professional full-service property management company that can handle everything for you from front to back, then you can just go on with life, focus on your friends, your family, your career, and focus on building your portfolio, increasing the size of that portfolio, looking for more deals. So I believe that 99% of the time you should just leave it to professional management companies to manage your portfolio. It's just a business expense. Just because you can save 7, 8, 9, 10%, on that fee, doing it yourself doesn't mean you should. So I think you should use professional management.
Yeah, I would agree on that as well. I think, leverage their experience. They can also help to, in their scalability, because, a lot of these property management companies that are pretty large, you can actually tap into some of their, maybe their insurance umbrella, so it kind of helps you to save on that. I mean, there's a lot of different reasons why, they're professionals, they've done it, they know the market, they know how to handle that type of tenant base. So there's really no reason for you to get involved. You focus on your business, not the property. That's really what it comes down to. So that was number 8. Number 9.
So number 9 is really more of a function of real estate, and that is maintaining control. Because if you're a direct owner, you are the CEO of your company and you call the shots. Now that doesn't mean that if you're involved in a syndication, the syndicators, and there's a good tight relationship there, there's trust and experience and all that stuff, that would fall under the classification of having maintained control. But you want to be a direct investor. And really what I'm talking about here is just don't hand your money over to a fund manager or somebody on Wall Street, like a fund or a REIT, a real estate investment trust, because you don't know what they're investing in. You have no say. You have no control. You don't know what the fees are, what's being taken off the front, middle, and back end of that deal. You're basically, and the other thing is you're investing in paper assets at that point in time. You're not really investing in real estate. Maintaining control means being a direct investor. And that means you own that real estate, not necessarily in your name. You won't hold title in your name, but in an entity, you or your friends, like that group, hold title to that real estate, and you have direct influence and direct control and direct reporting on what happens. And that's what I mean by maintaining control.
Okay, good one. Yeah. Okay, so last but not least, number 10.
Last but not least, and this is a huge benefit of real estate, and that is leverage your investment capital. There are still people out there that kind of subscribe to the whole Dave Ramsey, mentality of being debt free. The reality is there's good debt and bad debt, and good debt is really just using other people's money to control more real estate and still maintain 100% of all the benefits of real estate. You own that. But it allows you to take a small down payment, let's say 20%, maybe 25%, maybe 30%, and control 100% of that real estate you're investing in. So leverage really magnifies your overall rate of return. And in doing that, you control more real estate. And in doing that, that accelerates your wealth creation because now you have equity growth across more properties at the same time. So leverage is a super powerful thing with real estate because you can take a small chunk of cash, leverage it 5-to-1, and be able to acquire more real estate than you could as if you were an all cash real estate investor.
150% agree. Yes, I agree with you on that. So yeah, I appreciate all these 10 rules, and these are very 10 solid rules that everybody listening, even if you're experienced, you should always, follow these rules. They're They can really help you to get to that next level. If you're struggling by yourself, then there may be something that you're not doing right. Maybe you're looking at your own backyard too much. Maybe you need to be looking in other places. I love these 10 rules. So Marco, it is time for our Nuggets of Wealth. And so are you ready for these questions?
I'm always ready. Thank you.
You're born on the green light, huh? Okay.
Very well said.
So what is a good tool, source, or platform that you use almost daily that can also help others?
That's a darn good question. I've really tried to simplify my life, especially on the technology side. And I've just basically come to, I mean, this is going to sound simplistic, but I've really come to centralize everything into the Google G Suite, which is not just email, but it's all the Google in the cloud applications, Google Sheets, Docs, and all that stuff, Google Drive. I had files and stuff everywhere, not just me, but my entire team. So we've basically put the entire company into the Google Suite, and now everything lives in the cloud. We have access, we can control the shares, and it just simplifies and streamlines everything. And when you organize all your files in there, it's just so easy to find things. So not a great answer to your question, but
that's an outstanding answer, actually. And that is because I also use Google G Suite, and I find it, man, it's night and day. I love it. It's just so easy to use. Like, as you said, you have Google Docs, you have Google Drive. I mean, pretty much, Google Sheets, everything you need is right there. All consolidated in one spot. It's just easy to navigate. I love it. That's one of my favorite tools. So I'm glad that you mentioned that. So you gave us 10 different rules, and I don't know if you have any one other, but what is a top advice or tip that you would give to someone who is wanting to either get into real estate or maybe scale to that next level? What is one key thing?
It's very simple. The answer to that question is just simply do it. Like Nike says, do it. Take action. A lot of people are thinking about this. A lot of people listening to your podcast are thinking about it. A lot of them, and they're on different levels of that spectrum. Just finding out about it. They're a newbie. They just bought their first property. They're kind of stuck, and they're wanting to grow. Regardless of where you are, you need to identify what that next step is. Maybe it's picking up the phone. Maybe it's sending an email. Maybe it's calling one of my investment counselors. Maybe it's talking to you. But just do it. Take that next little step. If it's a big step, break it down into tiny little steps to make it feel like it's a baby step, but do the next thing. Most people fail because they don't take action. So they have the desire or the idea or even the knowledge, but they fail because they don't take that next step.
Yeah, and it goes back to maybe being fearful, fearful of being rejected, fearful of whoever they contact, gives them a no. I mean, if they give you a no, that's not the end of the world. Then you call them again next week. That's kind of the way it is. And then if they say no again, you call them again the next week after that. You just got to be tenacious. You have to have that tenacity, be ferocious, and just take action. I love your answer. What book are you currently reading?
What books am I reading?
Which book are you currently reading?
Oh man, there's tons of them. 5-Day Weekend by Nick Halleck. I'm about halfway through it.
I've never heard of that one. 5-Day Weekend?
Yeah, 5-Day Weekend. It's pretty good. It's it's a lot of stuff you already know. It's just kind of packaged a little differently, but that's good. Good book.
Sweet. Okay, we have to check that one out. 5-Day Weekend. Where do you see your business and company in the next 5 years?
Well, we're moving over 400 properties a year right now to people. We're helping hundreds of investors every year. To me, that's not enough. I think there's a lot more people that need to work on their financial freedom, their time freedom, their retirement, and their legacy. What they're going to pass on to their kids and their future generations. Call it generational wealth. A lot of people think about it again, but they don't do anything about it. So my goal is to 10x the business here in the coming years. Because we need to reach more people and help more people. We get emails almost every week saying, "Hey, thank you. You've changed our life. Your information is great. Your podcast is great. This and that." I mean, we constantly get thank yous, and that feels good because it helps you get up in the morning and want to do more of it, right? Mm-hmm. So yeah, I mean, that's the goal, is to 10x the business.
Okay, awesome. At the end of your life, how do you want to be remembered?
Probably for what I just said. And in addition to that, being a good husband, a good father, good grandfather, just someone who, gave back and helped educate people, especially from a financial perspective.
Got it. Okay. Where can Commit to Wealth Nation go to contact you and find out more about what you're doing? And, if they want to, get more involved in turnkey properties, where can they go?
We have two websites. A good starting point is passiverealestateinvesting.com. It's named after the podcast, passiverealestateinvesting.com. That's kind of the starting point. And both of our websites link to each other. The other one is our properties website, and that's noradarealestate.com, Norada, noradarealestate.com.
Gotcha. Passiverealestateinvesting.com and noradarealestate.com. So, Marco, I really do appreciate your time. Thanks a lot for these 10 rules of successful real estate investing. I hope that my audience found it, found them very valuable. And so I really do wish you continued success.
And to you too, sir. Thank you, Juan. It's been a lot of fun.
Yeah. Thank you so much.